Well, joining us now is Richard Bernstein. He is the CEO and Chief Investment Officer at Richard Bernstein Advisors. It's good to have you on, Richard. And given the fact that we did have a down day for the major averages, another down week for the major averages, what are you advising clients right now? How do you position yourself looking to next week, which is going to bring more macro data plus earnings season in a bigger, more meaningful way?
So Morgan, I think what's happening is that we're coming to the realization, or I should say the markets are coming to the realization, that the economy is much stronger than people thought. I think the key word to use there might be nominal economy. Real growth plus inflation is a lot stronger than people thought. And that means the probability of the Fed cutting rates, or I think if you really want to be a contrarian, you should start talking about the Fed maybe raising rates in 2025, means the liquidity trade is basically over. What's been the liquidity trade? Well, it's been the Mag 7, cryptocurrencies, all those kind of things. If you look at liquidity conditions, if you look at their performance, you see it's a very, very high correlation. That's probably ending, which means you probably want to err on the side now of the economy being stronger and the companies that have sensitivity to that stronger economy.
Now, I realize, especially in light of the hotter than expected data we got earlier today, that you have a market that is repricing Fed cut expectations to basically nothing for this year, and that in turn is pushing yields higher and then putting pressure on stocks. So there is this shakeout underway. But what would it actually take, and are you actually telling your clients that there is a possibility on the table that the Fed hikes again?
Well, I wouldn't say that that's our baseline by any means, but I think it's something that people should be considering. I mean, look, the leading indicators troughed several months ago. The Fed turned a blind eye to that. The leading indicators of employment have been strengthening. The Fed turned a blind eye to those leading indicators. And now they're finally coming to the realization maybe things are a bit stronger than they thought, or maybe a boatload stronger than they thought. We'll see what happens. So I think you really have to start thinking about, is there a possibility that the Fed may have to actually reverse course? I think that's what the market's trying to figure out right now.
So is this environment, with the data points we got today, better or worse for risk assets?
Well, I think it depends how you define risk, right? I mean, I would define risk as sort of cryptocurrencies in the Mag 7. I think for those groups, the risk is going up pretty dramatically. For most people, they would say risky assets are the things that haven't worked. And I think that's where the opportunity is, because they're going to be more economically sensitive and probably will surprise on the upside in earnings over the next quarter or two.
Any things in particular that haven't worked that you can highlight?
Well, I think there's things that have worked that people have ignored. In particular, I would point to things like mid-cap and small-cap industrial stocks. I mean, they've been outperforming the market for a decade, and, like, nobody cares. I mean, I think it's the greatest untold story out there. That would be certainly one place that I'd be looking. I'd be looking even at things like energy and even larger cap industrials. And I know mid and small cap are very out of favor. There's 85 reasons not to own them. But if we do have a couple quarters here of stronger growth than people think, mid and small might do pretty well.
We were talking to Mohammed El-Arian earlier today about this idea of U.S. exceptionalism when it comes to investing and where to put your money to work. Is that how you see it as well?
I'm not quite so sure. I think that the notion of U.S. exceptionalism is two things going on here. One, the U.S. has outperformed for 15 years. Nobody was talking about U.S. exceptionalism 15 years ago. It was all about emerging markets. So I think it's performance driving some of that. The second thing is that we have to come to the realization that the U.S. market is dominated by the tech sector. Right? If you look at places like Europe, they're very small tech sector. So if tech has been the driver of outperformance in this liquidity-driven period, naturally Europe's going to fade. However, if one were to think that maybe there's a recession looming, again, not our baseline, I don't think that's what people should be thinking about. But if you think there's a recession 25 into 26, Europe might perform pretty well because it's pretty defensive sector heavy. So there might be an argument to be in Europe if you think a recession's coming.